Next question. May 2018, question number 6b. It is a theory question. Here is the question, friends. What is certainty equivalent? So we are required to give answer over here for the CE factor. Dear students, we know that the CE factor is basically indicating that from every 1 rupee of the cash flow, to what extent you are certain is what the CE factor is indicating. Lower the CE factor is indicating that you are less certain, and higher the CE factor is indicating that you are more certain. That is the way we understand that we have CE factor, certainty equivalent factor, which is calculated as risk-free cash flow divided by expected cash flow. This is the way the CE factor is calculated. We understand that this is a method of incorporating risk in capital budgeting decision. It is a coefficient used to deal with the risk in capital budgeting context. It expresses risky future cash flow in terms of the certain or a risk-free cash flow which would be considered by the decision maker as their equivalent. That is, the decision maker would be indifferent between the risky amount and the lower riskless amount considered to be its equivalent. It is guaranteed a return that the management would accept rather than accepting a higher return but uncertain return. Calculation of the equivalent, that is CE factor, involves the following 3 steps. Remove risk by substituting the equivalent certain cash flow in place of the risky cash flows. This can be done by multiplying each risky cash flow by appropriate CE coefficient, that is expected cash flow into CE factor will become the risk-free cash flow. Obtain discounted value of the cash flow by applying, very good clarification that they have made, riskless rate of interest, that is RF. Apply normal capital budgeting method to compute the NPV using the firm's required rate of return. Means you are required to make the computation of the present value of the cash inflow minus investment is NPV. And of course, if at all the NPV is positive, the project should be accepted, not otherwise. Next question. November 18, question number 6C or the question says that write 2 main reasons for considering risk in capital budgeting decisions. The main reasons for considering risk in capital budgeting decisions are as follows. There is an opportunity cost involved while investing in a project for the level of risk. So whatever the risk that you undertake in this project, equivalent to that, say some other project is also there. Adjustment of the risk is necessary to help to make the decision as to whether the returns are out of the project proportionate with the risk borne and whether it is worth investing in the project. We know that the beta is one of the measurement of the risk that we have in the project over the other investment options available. Risk adjustment is required to know real value of the cash flow. So when you convert it into the present value term, it will give the real value of the cash flow. So these are the reasons because of which say we incorporate the risk in capital budgeting decision. It was asked in examination for 2 marks. Next question. It is May 19, question number 6A. The question says that explain the steps of sensitivity analysis. Steps involved in sensitivity analysis is as under. Sensitivity analysis is conducted by following steps. Finding variables which have an influence on the NPV or IRR, means selling price, variable cost, fixed cost, sales units, investment, life of the project, and so on. Establishing mathematical relationship between the variables means with the change in that variable, how the NPV is affected or how the return is affected. Analysis the effect of the change in each of the variable on NPV or IRR of the project. And we understand and say how to identify the sensitivity factor for the project. This was question asked for 4 marks in examination, and this is the suggested answer of the institute only. I have not made any change in this answer. May 19, question number 6C. Now friends, May 19 6C question was of the concept of the decision tree analysis. However, from May 20 onwards, there were certain changes introduced by the C Institute in which the decision tree analysis, simulation analysis, inflation, adjusted present value, chapter of the lease, all those have been eliminated from the syllabus. So even this question I have not kept. November 20, question number 6C. The question is that what is risk adjusted discounting rate? Here is the answer. A risk adjusted discounting rate is a sum of risk-free rate plus risk premium, means the additional return that you require due to the risk. The risk premium depends upon the perception of the risk by the investor of a particular investment and the risk aversion of the investor. Risk aversion of the investor is a point that we have discussed, that whether investor is aggressive, so he wants to take more risk, he is conservative, he wants to take less risk, like that. So the risk adjusted discounting rate is found as risk-free rate of return plus risk premium.